Hey everybody, how's it going? Matthew Kadish here, author of the Earthman Jack Space Saga, which you can go and check out over on Amazon.com if you want to support the channel and if you enjoy really great to mediocre science fiction. Today we are going to be talking about some interesting business news when it comes to Disney and their theme parks, in particular the new Star Wars Galaxy's Edge attraction. So this was brought to my attention by a blogger and Twitter friend of mine, Itchy Baka, who runs the website Disney Star Wars is dumb.blogspot.com. I will have a link to his article in the description of this video, but I just wanted to give a big shout out to him for bringing this to my attention because there's a lot of stuff to unpack here. And basically, I love Itchy to death, but he definitely has a bias against Disney. And his article was, not only analyzed the business end of things, but also kind of took into context this notion of Star Wars being on the decline, and mostly due to Disney's handling of it. And for those of you who might not be familiar with kind of the background of this stuff, when Star Wars Galaxy's Edge opened, a lot of people in what's called the fandom menace, which is a group of people who are upset with the direction that Star Wars is headed. They feel that Lucasfilm under Kathleen Kennedy and Disney under Bob Iger have mishandled the property and actually made very bad movies and attacked the fan base and split the fan base, and are continuing to head in a direction that a great number of Star Trek fans don't like, and they keep being attacked by those on the Lucasfilm end of things, people who work for the company and who are in the creative inner circle for determining the direction of Star Wars going into the future. And so there's kind of like a civil war going on there between the fan base and between a certain segment of fans and the people in charge of making Star Wars. And one of the battle lines that was drawn was with how Disney presented their new attraction, which is Galaxy's Edge, at the Disneyland theme park, and the one that's going to be opened in Disney World over in Florida. And there was some, big hype for the launch of Galaxy's Edge in Disneyland. And certain people of the fandom menace were kind of making videos and making tweets and articles and stuff about the failure of Galaxy's Edge, because basically Galaxy's Edge kind of discounts all the original trilogy and prequel trilogy characters in favor of the sequel trilogy, which isn't as popular among a big portion of the fan base. And it just goes to show that they were using that as proof that, Disney and Lucasfilm don't respect the Star Wars fans, because they completely leave out like characters like Luke and Han and Darth Vader and stuff like that, characters people love, in favor of characters no one's ever heard about, or sequel trilogy characters that no one really likes. And there was a lot of kind of coverage coming out with the release of Star Wars Galaxy's Edge that said that it was pretty much empty. Like there weren't a lot of people showing up for it, and it wasn't very popular, and fans were kind of rebelling against going to see it. And then you had the other side of that, which were the people who were kind of on the let's support Lucasfilm end of things, and we love The Last Jedi and all the sequel trilogy movies, kind of coming out and saying like, no, Galaxy's Edge is doing great. It's packed, like everyone's here, even though they never actually showed any real proof of that. But you had two sides of the argument. And with Disney's latest investor call, which happened the other day, Bob Iger basically got on the line and revealed a lot of interesting factoids about the current state of Disney, and that their third quarter has actually been in the red in terms of like revenue. Like they've actually taken a hit in terms of projected profit and stuff like that. But we're gonna dig down into it because it's not quite as simple as Star Wars is failing, Galaxy's Edge is failing, and all this other stuff. There's actually a little bit more to it than that. But what I wanted to do is I wanted to analyze this Bloomberg article that Itchy Baka kind of based his article on, and really dig down into what's happening here. So for those of you who are interested in the inside baseball of the entertainment industry and these big entertainment conglomerations like Disney, you can kind of get a sense of what's actually happening and what this means going forward. So we are over here on Bloomberg.com, and the title of this article is Disney Falls Most Since 2015 as Star Wars Stumble Slams Results. And this is by Christopher Palmieri. And we're going to get right into this. Walt Disney Company shares took their worst tumble in nearly 4 years after the opening of the most highly anticipated theme park attraction in the company's history fell flat, hammering results in its latest quarter. Profit at the company's domestic resorts slumped in the period, which was marked by the ballyhooed opening of Star Wars Galaxy's Edge, the largest addition ever to the Disneyland resort in Anaheim, California. A second version of the space-themed land opens in Florida this month. The report came after markets closed Tuesday, and the entertainment titan's high-flying shares fell as much as 6.8%, the most since August 2015, to $132.26 in New York trading Wednesday. All right, so Disney stock fell almost 7 percentage points to a value of $132.26 a share. Now, I want you to keep something in mind here. Even though the news is that Disney's stock fell in value, when Disney acquired Star Wars back in, 2012, 2013, something like that, the stock price was, I believe, around $100. After the acquisition of Star Wars, the stock price jumped up to $120. So what we're seeing here is since the acquisition of Star Wars, Disney stock has continued to rise. There's lots of reasons for that. But even though Disney stock took a hit, you got to remember that the stock market is fluid, and the trend for Disney, if you look at the chart, has been a rising one. So even though they took a short-term hit here, the overall trend of their stock has been upward. So that's important to note, especially considering from an investor and from an executive viewpoint, rising stock prices equate to them doing something right. So if the trend is to continue to grow the stock price, they're not so worried about an individual movie that doesn't do too well, like for instance, Solo bombing at the box office. They can say, well, Solo bombed, but that was an isolated incident because our stock value is continuing to go up. Okay, so moving on with that. The earnings shortfall was a shock to investors who were counting on Disney's market-dominating theme parks and films to shoulder the burden of growth as the company goes head-to-head with Netflix Incorporated in streaming. Spending on movies and TV shows for new online services led to a $553 million loss in Disney's direct-to-consumer division. Now, this is also important to note because for the longest time, Bob Iger has been saying that their shift to the Disney Plus streaming service, to these OTT, otherwise known as over-the-top services, which is basically a weird way of just saying direct-to-consumer. So they're cutting out the cable middleman and taking the content creator and going direct to the consumer so the consumer can subscribe to the content creator to deliver their content. Bob Iger has been saying for the longest time that they're fully prepared, the Disney board and the Disney investors are fully prepared to take a short-term hit in terms of profit because they know that this rollout is going to cost them a lot of money, but at the same time, for the future of the business and the future of the industry, this is going to be a long-term profit positive for the company. So he's been kind of Bob Iger's been setting the stage for quite some time now to let people know that the Disney board and Disney's investors are well aware that there's going to be some pain in the short term, some losses in the short term because of what they're doing. And that a lot of that comes from just them having to spend so much, not only to acquire, companies like Fox and Lucasfilm and stuff like that, but also in terms of ramping up the content needed to feed into these services to attract subscribers. So, for instance, like AT&T with their acquisition of Warner Brothers and stuff like that, they're taking on hundreds of billions of dollars in debt to further create content for their future streaming service, HBO Max. And Disney's doing the same thing right now. They're not taking on debt, but they're outlaying a whole lot of cash in order to do that. And so you see here where it says spending on movies and TV shows for new online services led to a $553 million loss. So Disney's already spent $500 million in ramping up their development and creation of new content in preparation for the Disney Plus streaming service, and you can bet your butt that shows like The Mandalorian and stuff are included in that price tag. Last quarter, the company released Avengers Endgame, the highest grossing movie of all time, as well as Aladdin and Toy Story 4. But Dark Phoenix, a Marvel movie inherited in the $71 billion acquisition of Fox assets, spoiled the party, and the company took a write-off on the film. Now, I actually covered this in a different video, which I will link to in the description. But the slate of Fox films that Disney inherited in the acquisition has been mostly scrapped. They had 3 big releases from the Fox films that they inherited kind of fall flat on their face, and Marvel's Dark Phoenix was the biggest flop of that. It was a $200 million movie. It grossed just over $200 million worldwide. I believe the domestic box office was something like $67 million. It was a huge flop, a huge write-off. So even though they've had all these big hits coming out of the Disney studios, the Fox movies have kind of been detracting from that. In fact, it was so bad that with the exception of maybe like 1 or 2 movies, Disney decided to pull all the remaining Fox releases from the release slate and just take a loss on them, basically. So basically, Disney didn't want to have to shell out more money for marketing, throwing good money after bad. And they just decided, to hell with it. We're just going to wait until we can develop our own movies with these Fox properties. Christine McCarthy, Disney's chief financial officer, acknowledged on a call Tuesday that fewer annual pass holders visited the company's California resort. She also said some potential visitors to Florida parks put off their trips to await the opening of the new Star Wars land there. Disney shares were up 29% this year through Tuesday's close, compared to 15% for the S&P 500 index, even though the Burbank, California-based company had warned of high cost in the years ahead as it presses into streaming. And so this is what I was talking about with Bob Iger, because he's been out there for quite some time telling people straight up, hey, we're going to be spending a lot of money. We're going to have some short-term losses because we're getting ready to launch a whole new platform that's designed to disrupt the TV and entertainment industry. But as you can see, as I said before, Disney shares were up 29% this year. So like a 30% increase in Disney share price in 2019 alone, which just goes towards that ever increasing graph. So Disney's, even though like this is bad news in terms of like, they underperformed the third quarter, there was a loss there. The overall trend in Disney is to be profitable. And they've also prepared their stockholders and their board of directors to know that they're going to be suffering in the short term as they lay out a lot of spending for their over-the-top streaming service. But in addition to that, there are some economics at play here that kind of go towards why the launch of Star Wars Galaxy's Edge didn't perform as well as most people think. We're going to get into that in a little bit. As the Star Wars opening approached, Disney tried to manage an anticipated surge in crowds at its California resort. For example, the company allowed only those with reservations to enter the attraction for the first 3 weeks. But social media was aflutter with images of lightly walked streets and short waits for attractions. Sales of Star Wars merchandise slumped, the company said Tuesday. Chief Executive Officer Bob Iger said that he didn't even need to advertise the new attraction, since anticipation among Star Wars fans was so high. But the company has since stepped up promotions of Star Wars Galaxy's Edge on billboards and social media. Disney also lifted restrictions on employees attending the attraction and introduced some discount pricing for season ticket holders. Okay, so one of the reasons, or one of the excuses that Disney's making for the failure of Galaxy's Edge to really bolster their profits here is that basically they were anticipating such a big crowd that they put all these restrictions on who could go into the actual park and stuff like that, that they kind of overdid it a little bit. And they made it so restrictive that, those big crowds never materialized. And thus, it actually discouraged people from coming to the park. But in addition to that, there are other reasons why people have stayed away. So basically, the cost of going to Disneyland has just gone up in general. So some people might have decided to stay away to save some money and maybe like vacation somewhere cheaper. But in addition to that, because of the estimated influx of people, hotels in the Anaheim area jacked up all their rates. So it became even more expensive to go visit Disneyland this summer than it has ever been before. So even if you were a season ticket holder, the cost of just staying at a hotel and the food and drink, and if you have a family of four, you're looking at thousands of dollars in cost just to go to Disneyland. And so that also combined with this perception that it was going to be super crowded and there were all these restrictions really served to keep people away from Disneyland this summer. And I think that's what you're seeing in terms of the lack of success. It's not so much Galaxy's Edge, even though Galaxy's Edge was kind of like the catalyst for it. It was just people took a look at their finances, took a look at the expense of going to Disneyland in general, and just said, you know what, some other time. We don't want to be paying these prices for it. So going on with the article, big miss. It all added up to a big miss for the usually reliable entertainment giant. Disney's profit, excluding some items, slumped to $1.35 a share in the quarter ended June 29, missing the $1.75 average of analyst estimates compiled by Bloomberg. Revenue missed forecast by more than $1 billion, with the company saying that the lower attendance led to reduced profit at its domestic theme parks. And this is just for the theme park division of Disney. That $1 billion loss was geared towards the theme park division. The movie division of Disney and the licensing division of Disney is still doing pretty good. But Disney, because it's so big and it has so many like individual pieces within it, you're kind of looking at this as a whole. So, even though the parks maybe missed forecast by $1 billion, the movies might have offset that a little bit, so it kind of balances out for just a minor dip. Because, like, if we're looking here, the estimate was Disney's revenue would go up $1.75 a share, and they missed that by 35, 40 cents, something like that. The market will be disappointed with the top and bottom line misses, said Richard Tripp Miller, founder of Julian Capital Partners based in Memphis, Tennessee. This is a transition quarter for Disney as they onboard Fox assets and spend capital to invest in the 3 direct-to-consumer products. And that's very important because Disney is in a transition period, especially after the Fox merger. They spent, $70-something billion to acquire Fox. They're going through a restructuring period. That's costing time and money and energy, where they're laying off people and they're reassigning people and all this other stuff. And they're figuring out a way to incorporate, the Fox properties into the Disney pipeline. But in addition to that, they're also gearing up for the big release of Disney Plus and all their streaming platforms. And so there's a lot of stuff going on with Disney right now. And it's all kind of contributing to them outlaying a bunch of money. And when expenditures go up, revenue can go down, especially like when certain things underperform. Profit at the TV division, Disney's biggest, rose 15%, buoyed by the cable division, which absorbed Fox channels including FX and National Geographic. Disney incurred restructuring charges of $207 million related to the Fox acquisition following the first full quarter of ownership. So as you can see here, Disney's TV division actually did fantastic in this quarter. It got some new networks involved in it. Disney owns ABC networks. And they've got a lot of stuff going on with the TV end of things, especially with their future streaming platform. But with the Fox acquisition, they've actually had to outlay over $200 million just to kind of incorporate all of the Fox personnel and the Fox business entities with their own. And that's kind of, been more outlier of expense. But as you can see, like the film division, the TV division, all this stuff, they're seeing good profits, whereas the amusement park division didn't meet expectations. So Iger said he has no long-term concerns about the Star Wars attractions. There was tremendous concern in the marketplace that there was going to be huge crowding when we opened Galaxy's Edge, and so some people stayed away, he said on a conference call. All the local hotels in the regions expecting an influx of visitation raised their prices, so it simply got more expensive to come and stay in Anaheim. Disney's own price increases may have also kept crowds at bay, he said. We feel great about the project. It could just take some time to have things to work themselves out. All right, so as you can see, Bob Iger doesn't look at this as a failure for Star Wars. He's looking at this as a failure in terms of local economics. Basically, they raised prices too much, and now that caused people to stay away. And that's what he's attributing this failure to. It's not that they messed up with Star Wars. It's not that fans of Star Wars are staying away. It's just that it was too expensive for the average park goer to come visit Anaheim this summer. And this is why things aren't going to change with Star Wars, because they always find excuses other than the fact that they're running the IP into the ground to justify certain types of failures. But that's not to say that their analysis is wrong. There's definitely been an issue here where Disney has raised prices too high and put on too many restrictions, and that's why the park underperformed. And when we see these things roll back, we're probably going to see an improvement over time. And Disney looks at the long game here, and the addition of Galaxy's Edge is meant to basically extend the value of the Star Wars property to their amusement park businesses, which are a big part of their profit model going forward. So, whether or not this is actually an issue with Star Wars, can be argued. I personally think that, if they treated the IP a little bit better, it'd probably be better. They'd probably see a bigger improvement in merchandise sales and stuff like that, because things at Galaxy's Edge are insanely expensive. So when the prices kind of stabilize, when they pull back and the restrictions come off, it's probably going to be better. But I guess we'll see. Anyway, what do you guys think about this news? Do you think Disney's on the right track? Do you think Disney's running Star Wars into the ground and that's why this is happening? Let me know your thoughts in the comments. And as always, subscribe to my channel for more movie, TV, and entertainment business news and analysis. This is Matthew Kadish. I will catch you guys in the next video.